Good day, everybody. This is Grace Maureal, your reporter for Budgeted Balance Sheet. A budgeted balance sheet is a report that management uses to predict the levels of assets, liabilities, and equity based on the budget for the current accounting period. In other words, the budgeted balance sheet shows where all of the accounts would be at the end of a period if the actual company performance matched the budgeted estimates. Preparing this report is usually the last step in finalizing a master budget plan. The budgeted balance sheet contains all of the line items found in a normal balance sheet, except that it is a projection of what the balance sheet will look like during future budget periods. It is compiled from a number of supporting calculations, the accuracy of which may vary based on the realism of the inputs to the budget model. The budgeted balance sheet is extremely useful for testing whether the projected financial position of a company appears to be reasonable. It also reveals scenarios that are not financially supportable, such as requiring large amounts of debt, which management can remedy by altering the underlying model. A budgeted balance sheet should be constructed for each period spanned by the budget model rather than just for the ending period, so that the budget analyst can determine whether the cash flows estimated to be generated will be sufficient to provide adequate funding for the company throughout the budget period. Preparing a projected balance sheet or financial budget involves analyzing every balance sheet account. The beginning balance for each account is the amount on the balance sheet prepared at the end of the preceding period. Then, managers consider the effects of any planned activities on each account. Many accounts are affected by items appearing in the operating budget and by either cash flows or outflows. The complexities encountered in preparing the financial budget often require the preparation of detailed schedules. These schedules analyze such things as planned accounts receivable collections and balances, planned material purchases, planned inventories, changes in all accounts affected by operating costs, and the amount of federal income taxes payable. Dividend policy, inventory policy, financing policy and constraints, credit policy, and planned capital expenditures also affect the amounts in the financial budget. So, continuing our illustration, our budgeted balance sheet will look something like this. The figures that we will put in the cash column are those derived from our cash budget. Remember from the previous reporter that in the cash budget, the ending balance for each period represents the cash receipts less the payments made for manufacturing costs, direct materials, direct labor, and overhead, as well for the operating and general administrative expenses and any finance costs. The receivable account reflects those credit sales that are not collected within the month of sale. In our assumption, 20% of sales are collected in the month after the sale period. In many cases, management also should take into account the portion of the accounts receivable that may be deemed uncollectible and so classified as bad debts. From the direct materials budget, we can get the ending balance for our raw materials inventory. The purchases in the period, including the returns and allowances, as well as those issued to production, determines the figures presented in this account. On the other hand, the finished goods inventory balances are derived from the production budget. In our illustration, all raw materials used in the production are transformed all into finished goods in the end of the process. We don't have a work-in-process inventory as in the case of small-scale production. But that will not be the case in some big factories. Over time, the delivery equipment will depreciate, and in this budgeted balance sheet, we can see that the company provided for a 10,000 monthly depreciation. At the end of each period, we have varying total assets. In the liabilities section, we have our accounts payable balances derived from the purchases on account, less payments made on those credit purchases, as can be seen in our cash budget. The income tax payable represents the 30% aggregate taxes that are payable from our assumed level of sales, less the cost of the goods sold and operating expenses. The loans payable account has a decreasing balance because we have programmed in our cash budget for the payment of a 20,000 monthly amortization. The total liabilities is reflected thereafter. In the equity section, we start with our beginning. The beginning capital of the current period is the previous period's ending capital. Net income is derived from the sales budget. Capital beginning added with the net income determines the ending capital balance. The total liabilities and equity is then reflected. It should be equal with the total assets, as I have presented a while ago. As can be gleaned from our illustrated budgeted balance sheet, the company predicted differing levels of assets, liabilities, and equity. Cash is gradually increasing, as well as the receivables brought about by the high level of estimated sales and credit policy of the company. As our example is not complex, the increase in the aforementioned assets would also mean an incremental increase in the equity of the company, as there are no new liabilities aside from unpaid taxes and purchases. The budgeted balance sheet shows where all of the accounts would be at the end of the 3-month period if the actual company performance matched the budgeted estimates.